But very few people talk about electricity. Think about this. Every new AI data center consumes enormous amounts of power. As more facilities are built across the United States, electricity demand is expected to increase significantly over time. That creates opportunities in industries many people consider boring. Utilities, power infrastructure, grid modernization, electrical equipment. These businesses may never become social media sensations, but they provide something every AI company needs: reliable energy. Sometimes the quietest industries become the biggest long-term winners. Because without electricity, none of the technology works. Stock idea number 5, Caterpillar. Now, this next company surprises many people. Caterpillar. At first glance, you might wonder, what does construction equipment have to do with artificial intelligence? Actually, quite a lot. Building new factories, expanding manufacturing facilities, constructing data centers, improving infrastructure. All of these projects require heavy equipment, and Caterpillar has spent decades building one of the strongest brands in that industry. As governments and private companies continue investing in infrastructure and industrial development, businesses like Caterpillar can benefit from increased demand. Another advantage is diversification. Caterpillar isn't dependent on just one customer or one industry. Its business reaches construction, mining, energy, and industrial markets around the world. That doesn't eliminate risk. Economic slowdowns can reduce equipment demand. Commodity prices can influence customer spending. But that's exactly why investors monitor long-term trends instead of reacting to short-term headlines. The goal isn't predicting next month's stock price. The goal is identifying businesses capable of creating value over many years. Healthcare, a sector that never stops innovating. Now let's move away from technology for a moment. One mistake many investors make is concentrating everything in one sector. Diversification exists for a reason. Healthcare has consistently been one of the most resilient sectors because demand doesn't disappear during economic uncertainty. People continue needing treatments. Hospitals continue operating. Medical research continues advancing. And that's why healthcare deserves a place in many long-term portfolios. One company attracting significant attention is Eli Lilly. The company has experienced remarkable growth through innovative medicines, particularly in areas like diabetes and weight management. Beyond current products, investors also watch the company's research pipeline because future treatments could create additional growth opportunities. Of course, success also brings higher expectations. Stocks with strong growth often trade at premium valuations. That means investors should carefully evaluate whether future earnings can justify today's price. Again, a great company isn't automatically a great investment at every price. That's one of the most important lessons every investor should remember. Building a portfolio that can last. Now we've looked at several companies across technology, infrastructure, industrials, and healthcare. But here's something that's even more important than picking the perfect stock: how you build your portfolio. Because even if you choose great businesses, putting all your money into one company or one sector can dramatically increase your risk. The truth is, no one, not even the world's best investors, can predict exactly what the market will do over the next 6 months or even the next year. That's why successful investing isn't about being right every single time. It's about managing risk while giving yourself the opportunity to grow your wealth over many years. So instead of chasing the latest trend, think about building a portfolio that can benefit from different parts of the economy. Stock idea number 6, Visa. One company that has consistently demonstrated long-term strength is Visa. Most people don't think about Visa very often. They simply tap a card or make an online payment. But behind millions of those transactions is one of the world's largest payment networks. As digital payments continue replacing cash around the world, Visa benefits from the increasing volume of transactions rather than from lending money directly. That's one reason many investors admire the business model. The company has built a powerful global network that's difficult for competitors to replicate. It's not the kind of stock that usually doubles overnight. Instead, it's the kind of business many long-term investors appreciate because of its consistency, strong profitability, and durable competitive advantages. Sometimes slow and steady really does win the race. Stock idea number 7, Walmart. Now let's talk about a company almost everyone knows. Walmart. Some people overlook Walmart because they think of it as just a retailer. But today's Walmart is much more than that. The company continues investing in e-commerce, grocery delivery, automation, and technology to improve efficiency and serve customers in new ways. During uncertain economic periods, many consumers also become more focused on value, and that's an area where Walmart has traditionally been very strong. For long-term investors, companies that continue adapting to changing consumer behavior can be valuable additions to a diversified portfolio. Again, this isn't about chasing excitement. It's about owning businesses that continue serving millions of customers year after year. Stock idea number 8, JPMorgan Chase. Finally, let's look at the financial sector. Banks play an essential role in the economy, and one of the names many investors watch closely is JPMorgan Chase. The company operates across consumer banking, commercial banking, investment banking, wealth management, and financial services. That diversification gives it multiple sources of revenue rather than depending on one single business. Financial companies can certainly face challenges when interest rates, regulations, or the economy change. But high-quality institutions with strong balance sheets have often shown resilience through different market cycles. For investors looking to add exposure to financials, researching companies with solid fundamentals can be a sensible approach. A simple framework for 2026. Now, you might be wondering, how do I actually put all of this together? There isn't one perfect portfolio for everyone because every investor has different goals, different risk tolerance, and different time horizons. But many long-term investors follow a balanced approach instead of concentrating everything in one area. For example, a portion in technology and AI infrastructure for long-term growth. A portion in industrial and infrastructure companies that could benefit from increased investment spending. Exposure to healthcare for stability and innovation. High-quality consumer and payment companies for consistent long-term performance. Financials for diversification. And perhaps most importantly, keeping some cash available. Why? Because opportunities often appear when markets become fearful. Having cash allows you to invest when prices become more attractive instead of feeling forced to sell during downturns. The power of dollar cost averaging. Here's another strategy that's simple but incredibly effective. Dollar cost averaging. Instead of trying to predict the perfect day to invest, you invest a fixed amount at regular intervals. Sometimes you'll buy when prices are high. Sometimes you'll buy when prices are lower. Over time, this approach helps reduce the emotional pressure of trying to time the market. History has shown that staying invested consistently has often been more effective than trying to predict every market movement. Patience is one of the greatest advantages an investor can have. If there's one message I hope you take away from today's video, it's this. Don't invest because of excitement. Invest because you understand the business. Great companies don't become great investments simply because they're popular. They become great investments when they're backed by strong fundamentals, healthy cash flow, durable competitive advantages, and the potential to grow over many years. The market will always have ups and downs. There will always be breaking news. There will always be predictions about the next boom or the next crash. But investors who stay disciplined, continue learning, diversify their portfolios, and focus on long-term quality have historically put themselves in a stronger position than those who constantly chase the latest headline. So before buying any stock, ask yourself 3 simple questions. Do I understand how this company makes money? Can this business still grow over the next 5 to 10 years? Am I comfortable owning it even if the market becomes volatile? If you can answer those questions with confidence, you're already thinking more like a long-term investor. I'd love to hear your thoughts. Which company on today's list interests you the most? Is there another stock you believe deserves attention in 2026? Share your ideas in the comments below. Reading different perspectives is one of the best ways to continue learning as investors. And if you found today's research helpful, consider supporting the channel by liking this video, subscribing, and turning on notifications so you don't miss future market updates and investing discussions.